This lesson is going to show you how to read volume. Volume analysis in crypto trading can give us valuable insights for making better decisions. It can confirm trends, it can confirm trend reversals, it can give you warning signs, and it can give you confirmation of your current trade. In this lesson, I talk about basic volume, which is the horizontal histogram on your chart. There are other types of volume analysis. They are also covered later on in the course. So here is a summary. First of all, you can see on the screen what it actually is. So you have your candlestick chart. You then put on, either on TradingView or on your exchange app, you just type in volume into the indicators tab, and it is the first one, basic volume. You add it to the chart. You can go into settings and see if there is a moving average option, which there should be, and you can add the moving average. Why is that important? Well, that is the easiest way to visualize by just glancing at the chart whether volume is above average or below average, right? That is going to be very important for you because you need to denote whenever volume is doing something abnormal. So using that, let's take it forward and look at a summary of all the various ways you can read and interpret volume. First, we use volume to confirm price movements. High volume confirms strong price movements, while low volume suggests an unreliable move. So, on a chart, if the market's moving up and there is high volume on an impulse up, then we have another impulse up and it is on lower volume, that is not a good sign. That is suggesting an unreliable move. If we have a breakdown, where price breaks down through a low, but the volume appears to be very weak, that is a sign of lack of conviction in the market from sellers and an unreliable move. Whereas if we are trending up and we impulse higher with high volume, we then go higher again with even higher volume, we then break higher a third time with even higher volume, that suggests a very strong trend that will continue until something changes. Second way we can use volume is for trend reversal signals. Significant changes in volume can indicate potential trend reversals. So at the bottom or at the top, if you get particularly high volume and failure to continue, that can equal a reversal. So what that means is, if you see a large spike upwards or downwards and the price does not go higher or go lower and it starts to creep in the other direction, and you notice there was really high volume on that impulse, that is a sign of a reversal because a lot of people have entered and exited the market at that point and price has failed to continue. So high volume can show us the end of a trend. Support and resistance, we can confirm those using volume because whenever price reaches a key level, if it reaches there and has high volume and holds, that is an important indicator of support and resistance. So when price revisits a level that you know from before is support or resistance, you see an increase in volume and the level does not break, that's a clear sign that is valid support or resistance and you can trade in the opposite direction. High volume will give us a breakout confirmation. So whether it's a breakout to the upside or breakdown to the downside, volume confirms the strength of these breakouts, both bullish and bearish. You want to see, for continuation, price moving through a level, breaking down or breaking out, closing strong, and volume being increased. It should be above average, above that moving average line, and it should ideally be bigger than any of the volume that has preceded it in the trend. That would signal continuation and a valid breakout. You can then employ breakout trading strategies. Fifth way, as happens so much in all the TA that we do, divergence is super important. We've talked about the theory from it in Wyckoff. You now get to use it in real time. Volume, how do we use it in divergence? If you notice a divergence between price and volume, it can signal trend weakness or reversal. Very simple. If price goes up, volume is going down, that's a sign of a weak trend and it'll probably going to reverse. If price is going down, but volume is not supporting it, so price continues down, but volume does not continue going up, again, that's a divergence. Any divergence you've seen between price and volume can signal trend weakness and indicate a reversal. It's very simple. If a trend is going to continue, the volume should continue to be strong. Final way, this is more of an overall view, it's not really for trading, but volume can help you assess the liquidity of a market. That might not seem important because you don't run into liquidity problems if you've got a small account, and even if you've got a big account, you generally never run into that. But you want to know the state of the market. It's very important to know who is trading. If you have really high volume, it indicates a lot of participants. It also indicates that bigger players can play in the game. If you're trading multiple millions or even billions of dollars of volume a day, that means almost anybody, any institution or any smart money can trade in it. But if there's only a handful of million or even a few 100,000 of volume, it's a very limited set of participants who can trade in it. So by understanding market liquidity, you can really begin to understand the market as a whole. You can also understand when the market is likely to be bullish or bearish. Because if market liquidity is bad, that is never a good sign. Low volume generally means low interest from both big players and from retail. It typically means the market is not going to be one that's really great for trading. And on the flip side, high volume will attract bigger players into the market. Now let's look at some examples. I'm going to show you how to use volume for breakouts, for divergences, and to notice support. Here is a breakout confirmed with volume. You have a level, a swing low. Price consolidates, it then breaks through that swing low and closes, and you see significantly increased volume well above the moving average. The significantly increased volume confirms the breakout is valid, sellers are in control. That is a confirmed breakout with volume. Next, we look at a divergence. So in this instance, price goes higher, yet volume goes lower. That's a divergence. If the trend is strong and continuing, it should make new highs with higher volume. Because it doesn't, you then should be on the lookout for trend reversal. Your strategies for shorts should be employed, and you can enter into a high probability reversal. Finally, looking at confirmation of support using volume. So we previously set a support level. Price came down, it held here, it had a significant rally. On the revisit to it with extremely high volume, price does not go through, it respects the level, and you see even on the subsequent tests, that level proves to be extremely strong and leads to a new trend up. The high volume retest of support indicated that the level should hold, and it did. So there are 3 real-world examples of how you can use volume analysis to trade better. Now let's get through to the next lesson.